It has been some time since I showed you guys my portfolio. On the left was my portfolio last time I showed you guys it. A lot of stocks have changed, a lot of stocks have stayed the same, so let's go into it. My current biggest position is Alibaba. Currently the allocation is smaller than before, but that's not because I sold Alibaba shares. Matter of fact, I added a few, not a lot, but I added some. But my portfolio is still relatively new. I started investing a few years ago. And still, the money I put in and the dividends I receive still helps my portfolio grow quite fast. Plus, a lot of other stocks I have performed way better. Alibaba had a big run-up over the last month. They had their giant run-up a few months ago. I didn't sell any shares. When it came back down, I bought a few shares. But overall, I've just been holding this company since some time. The growth prospects over time are still great. Cloud is reaccelerating. They're increasing the take rate in their e-commerce business. They're buying back a huge amount of shares. My intrinsic value is $150 per share, so I'm not even close to selling this stock. My second biggest position is Mercado Libre. I owned the stock before at 5.5%. I added a lot of money into this, put some of the money of the positions I sold off into it, because I just think it's a very great buy right now, and especially a few months ago. Mercado Libre operates in South America. They're slowly becoming a bank there. They're offering e-commerce and logistics, and I just think they're building up a giant moat in South America that not even Amazon can breach. And over the last year, they had a few giant dips, especially around December, and I added a lot of shares there. So this position has done fairly well for me so far. I've had other positions that outperformed it, but overall, I think it's a great buy. My intrinsic value is around $2,900 per share. I'm not adding to it right now because I have other buys, but it is fairly high on my list of potential buys. Now, next up, CVS. It has become a bigger part of my portfolio, mainly because I added a lot of money into it. It has not performed well. CVS, the giant health insurance company with the pharmacies in the US, I started buying a small position in the higher 60s. When it crashed, I slowly made it a bigger position. Overall, it has kind of flopped around since then. During the big crash around December, I added a few shares, so overall I'm in the positive, but it has definitely not been an outperformer. I don't see anything wrong with the company right now. They have a lot of issues when it comes to pressures on Medicare, and I just think this is gonna take some time. Historically, great growth. They took on a bunch of debt because of some acquisitions, and they're now gonna have to slowly pay that off once the free cash flow comes back. And overall, I'm happy sitting on my position right now. My intrinsic value is around $90 per share. However, there is some risk with this company, so I do not want to increase my position much more beyond this, except if it would fall down even further. Airtel Africa, I still own the stock. It has not moved much in allocation. They offer telecommunication services in Africa and mobile money. So basically they're part fintech, but they're mostly, of course, the traditional telecommunication. They have been hit really hard over the last few years because of currency devaluations in Africa. When the entire world started raising their interest rates, a lot of people flocked to the safer currencies, like the dollar, like the euro. So the African currencies have not performed well. And when you have a company that is listed in British pounds and reports in dollars, obviously the revenue is going to decline if your local currencies depreciate. However, it is starting to turn around, it is back to growth, and slowly that is being acknowledged by the market. The stock is up very nicely, so I netted so far a good amount. However, I usually only buy if the stock is in a giant dip, which happens fairly often. If you can see, for a long time the stock has been up and down, so I'm not really adding right now, despite it being undervalued in my opinion. The intrinsic value is around $270 per share, but this is a fairly high risk stock because of these local currencies. If these local currencies depreciate, despite the company growing, you don't see any profit. Once again, this is why I'm not adding more to it right now unless the stock falls to like $1 per share, which we see quite often. However, I'm happy sitting on this position. Next is XP. I have not owned the stock before. It has been a giant buy for me, and as you can see, it's taking up a huge chunk of my portfolio now, despite not being in there before. XP is a mainly brokerage platform in Brazil. I bought it because it had amazing growth. They had some weak quarters because of Brazil raising their interest rates very harsh when the rest of the world was cutting this, while the Brazilian real was also depreciating. So they were really hit from two sides. Brokerages do way better in low interest rate environments, so growth rates have been kinda lowered, but I don't see anything going against them returning to their high double-digit growths. They started buying back some shares, plus they're paying out a nice dividend. Now, here I gotta say, before Heidenberg Research closed down, they were preparing a short report against XP, calling it a fraud. They didn't really show any concrete proof yet, at least, that this is a fraud. It has something to do with their overseas positioning. They have a lot of offices in the Cayman Islands, etc., etc. Hindenburg was hinting that those companies commit in some kind of accounting fraud. So this is a higher risk position because it is mainly in Brazil, and because of that, but I'm adding to it because I just like the company, I like the growth prospects, and I didn't really see any concrete evidence that it was fraud yet. Kind of skip this position, medical properties. Their hospital REIT in the US, I owned that for some time. I started buying on the dip down, and I bought a lot of shares in the lower range. Together with the dividend, I came out around equal. It wasn't really a good position to be in. What was the issue is they had a lot of investments in their tenants. They gave them a lot of loans, and when the tenants went bankrupt, those loans also defaulted. Now, I was basically counting on them stopping that, not giving any more money to their tenants, paying down the debt slowly. Of course, the revenue was not going to be there while the hospitals get re-tenanted, but the issue is they just kept giving loans to the tenants. And eventually I just said, well, I don't want to see that, just sold the shares. And while the company might be improving, I just do not like seeing that. So for that reason, I am out. I'm not buying into the stock right now, even if the earnings report is gonna be good. My next stock that I bought is Yalla Group. It's a fairly small company, only 664 million. They operate a social networking app called Yalla that is mainly addressed to Arabic speakers. Plus they have a few gaming apps which they recently got into. So it's not really a gigantic company, but it's trading at a 5 PE. And when you look at their investments plus cash, it is more than their market cap. So I just overall like this company because of that. Low PE, market cap is completely covered by cash. I think this is a very low risk stock. This is a position which covers areas of the world like the Middle East and North Africa, which are not really covered by my other stocks. I'm heavily buying more of these shares. Now, my position there before was BTI, British American Tobacco. This is a dividend stock, as you know, tobacco stock, slowly switching into more lower harm categories like vapes, oral tobacco, and this is a stock which I've been in and out over the last few years. Whenever the dividend yield is very high and the stock is trading at very low points, for example, it was trading into the 30s, and I bought in these low ranges because at this point I got a 10% dividend yield while they were paying down a lot of debt. However, as the stock kept shooting up more, I just slowly sold off the position in some parts. I might be into the stock next year again. Who knows? I owned it before here, sold it around the 40s, bought it back around here in the 30s to lower mid-20s. It is just a come and go whenever I don't have anything better to do with my cash and the stock is trading at a very low point. I like adding to it. I don't really see anything wrong with this company. I also sold off Acomo, Amsterdam Commodities. They trade spices, nuts, tea, and basically their business model is slowly grow revenue over time, do a big acquisition. When you did the acquisition, slowly pay down the debt, repeat that, buy new business, and so on. It's basically a roll-up company. They do that while paying out a nice dividend. And I bought this stock because it is kind of nicely valued. I still think it is. It didn't move much since I bought it, but I just found better buys. So that is the whole reason. I still think it's a great business at a very low risk, but I just found better buys. Now the next stock that I bought was Dollar General. This stock has massively crashed. I started buying it around the $75 mark around here. Slightly down on it. It's a fairly new position. They're still growing revenue. Their profit was hit fairly hard by lower income consumers currently being squeezed by inflation. Dollar General is positioned in very poor areas of America, and in these areas they have no competition. But the issue is their spenders are very low income people, and low income people basically cut down on all unnecessary spending, only going to the essentials like food, clothing, etc. And that hit Dollar General pretty hard. The cash flow is still there, plus they're still growing a lot of stores, capital expenditures are still fairly high, and they're starting to reduce debt. So I'm buying the stock just with the thought that soon it's going to turn around once the low income people are back to spending, and I don't really see the stock being this low for the long term. My intrinsic value is around $100 a share, so it's not hugely discounted right now, but it's a fairly safe buy. I was also very conservative. For every stock I own, I basically have, or should have, I don't think I forgot any, should have a video on my channel. On that you will always see how I come to the intrinsic value. Sometimes I updated it a bit since then, but it's mostly around that. Now another stock, which was a very recent video, Sone. They're a giant holding company and are very active mainly in Portugal, but also across the world when it comes to retail, real estate, internet services, cinemas. They just recently bought a giant pet portion, veterinary clinics, pet food, etc. So I really like it because for low valuation, high dividend yield, long-term revenue growth. My very conservative estimate is €1.40 per share, so still a lot of upside, and it is the stock I'm currently putting most of my money in because I think it's one of the safest buys I have in my portfolio, for lowest risk and a very good upside. Now before we come to the latest stock, Hornbach. I had a very lucky timing with Hornbach. I bought shares in the kind of lower ranges here, and I sold them because I just found other stocks like Sone which I really wanted to put my money in. And right after I sold them, they released a bad earnings report. I don't think it affects the company long term, but it was just a lucky big sell. I might add into it in the future again, but this is why I sold Hornbach. It was a fairly lucky sell. It wouldn't have anything against it, still holding it. So, and the last company, which I still own, Asbury, they're basically just a car dealership group. I sold like half my position to put it into Sone, because just recently they released the earnings, and I don't know why, it wasn't stellar, but the market really rewarded them. The stock shot up hugely. I just think it's kind of approaching a point where I say, hey, I don't want to have this stock. And while I still think it's at fair value and kind of below, it's not that attractive to me anymore. I bought it in around 220s, but overall, I don't think the upside is that much more of the stock, so I sold it and bought better positions. So this is my portfolio right now. I'm fairly happy with it. It has performed really well recently because of Alibaba, Mercado Libre, Airtel Africa, and even XP's recovery over the last few weeks. If you ask me where I would put my money most right now, it would probably be Sone and Yala Group. This is where I would be putting most of my money right now. What do you think about it? Write it down below. Have a good day.